International investment theories. Definition and detailed explanation. Definition. International investment theories are a set of economic and business models that explain the reasons, methods, and patterns of investing across national borders. These theories help us understand why individuals, firms, and governments allocate capital to foreign countries, what influences these decisions, and what types of benefits or risks are involved. International investment typically takes two forms. Foreign direct investment, FDI, when a firm invests directly in business operations in another country, e.g., building factories, acquiring companies. Portfolio investment, when investors purchase financial assets, stocks, bonds, in another country without having control over the business. Magnifying glass. Detailed explanation of major international investment theories. 1. Classical and neoclassical theories. A. Theory of comparative advantage developed by David Ricardo. A country should specialize in producing and exporting goods it can produce more efficiently and import what others can produce more efficiently. Application to investment. Capital will flow to countries where it can be used more productively, reinforcing comparative advantages. B. Neoclassical theory of capital movement assumes perfect markets, no taxes, no restrictions, and full information. Capital flows from capital-rich, developed, countries to capital-poor, developing, countries where returns are higher. Based on the law of diminishing marginal returns, more capital in a country lowers its additional return. 8. Spoked asterisk limitations. In real life, much of global investment still flows between rich countries, not necessarily to poorer ones. 2. Dunning's eclectic paradigm, Ole framework, created by John Dunning. This is the most widely accepted theory of foreign direct investment, FDI. Check mark. Ole stands for O. Ownership advantage. Competitive advantage the firm possesses, e.g., brand, technology, know-how. L. Location advantage the target country offers advantages, e.g., natural resources, cheap labor. Large market. I. Internalization advantage, it's more beneficial for the firm to control the foreign operations rather than license or outsource to another company. Example. Toyota invests in the US because it owns superior manufacturing tech. O. The US market is large. L. Controlling production internally ensures quality. I. 3. Product life cycle theory, Vernon. 1966. Explains international investment over a product's life cycle. Stages, innovation, home country, new product developed. Maturity, export, product is exported as demand grows abroad. Standardization, FDI. Production is shifted overseas to lower costs. Example. US firms produce smartphones locally, then move production to Asia as the product becomes standardized. 4. Internalization theory. Firms internalize operations abroad to avoid market inefficiencies. Explains why firms prefer to establish subsidiaries rather than license or franchise. Reduces risks like intellectual property theft, quality control issues, contract enforcement problems. 5. Market imperfection theory. Markets are not perfect. Information gaps, taxes, tariffs, and other barriers exist. Firms use FDI to overcome these imperfections and take advantage of unique firm-specific assets. Examples: patents, brand equity, skilled management. 6. Portfolio investment theories. A. Modern portfolio theory, Markowitz, diversification reduces risk. By investing in foreign assets, investors can spread out risk if those assets don't move in sync with domestic ones. B. Capital Asset Pricing Model, CAPM, calculates expected returns on an asset. Extended to international markets by adding exchange rate risk, country-specific risks. 7. Gravity model of investment suggests investment flows are strongest between large economies, geographically close countries, countries with cultural, linguistic similarities. Example, the US invests more in Canada than in a distant developing country, even if the return is similar. 8. Behavioral and institutional theories. Behavioral theory investment decisions are not always rational. Firms are influenced by past experiences, risk aversion, and organizational culture. Institutional theory looks at the role of laws, politics, and norms. Firms prefer to invest in countries with stable governments, transparent legal systems, low corruption. Bar graph summary table of theories. Theory focus explains investment type, comparative advantage, efficiency, resource allocation, FDI. Portfolio neoclassical return on capital. Capital flows to high return areas. Portfolio OLI, Dunning, ownership, location. Internalization firms' decision to invest abroad. FDI product life cycle stages of product. FDI in late stages to reduce costs. FDI internalization transaction cost reduction. Why firms internalize foreign OPS. FDI market imperfection market barriers. Why firms choose FDI over licensing. FDI portfolio theory risk return diversifying investments. Portfolio gravity model size and distance investment patterns. FDI behavioral institutional psychology rules decision influenced by context. Both checkmark. Final thoughts. Understanding these theories gives insight into how multinational companies decide where and how to invest, how global financial flows are shaped, why FDI doesn't always follow classical expectations. If you'd like this as a PDF